Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're gonna go through Twitter, see what people are sharing on social media. I'll interject my financial opinions. It's generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive right in. Let's take a look and see what people are sharing, and then I'll interject my opinions as we go. If you want to follow me on here, it is at finding_finance. And if you want to join our community, finding-value.com, where I dive deeper into all of these topics about investing. And sometimes I do training courses or opinions on strategies for investing for this commodity bull market and or for really any market that is out there. But commodities are the ones that are in favor right now for valuation. Money Wisdom, Morgan Housel says, you might think you want an expensive car, a fancy watch, and a huge house, but I'm telling you, you don't. What you want is respect and admiration from other people, and you think having expensive stuff will bring it. That's pretty deep, actually. Here's Kevin. The global average time to build a mine has increased to nearly 16 years. The shocking aspect of these calculations is that they assume the macro environment we experienced over the last 20 to 30 years. This is huge, guys, right here. This is massive. They assume low energy costs, historically low interest rates, a more globalized environment, relatively low labor costs, and low material costs. We are currently facing almost the complete opposite of this situation. Additionally, ESG efforts will likely exacerbate the situation, creating one of the most constrained long-term supply dynamics in metals we have seen in history. Moreover, the construction boom driven by onshoring, revamping the electric grid, new data center developments, new industrial capabilities, and infrastructure developments are all poised to increase the long-term demand for these commodities. Ironically, despite the challenging cost environment, the likely surge in metal prices will pave the way for one of the most bullish periods for the mining industry, making it an increasingly vital and strategic sector for the global economy. More importantly, the looming supply cliff for existing reserves among major companies is expected to ignite one of the most intense merger and acquisition cycles in the industry's history. In the decade ahead, those holding high-quality exploration and development stage assets are likely to emerge as major winners in this environment. And time required to build a mine, 15.7 years is the average. So, I have a lot of ideas of what I think are the best exploration development projects in the world for various sectors. And then I concentrate a little bit of money into a few of what I think are the best possibilities in the markets on the website. Here's another one from Kevin Smith. I don't know if I'm going to read through. Oh, yeah, I can read through all this one. It says, the recent report on the U.S. trade balance shows a continued and substantial decline, primarily driven by a significant increase in imports. At first glance, this might seem irrelevant. However, when a country also runs a fiscal deficit exceeding 6% of GDP, a trade balance deficit approaching 4% is certainly noteworthy. We've got this trade balance just declining like no other here. Something weird's going on here, guys. And he talks about the U.S. twin deficits to GDP. This is not good. We have a lot of debt. And when debt outperforms GDP, when it grows faster than GDP, that is inflation. It's bad inflation. I know that we talk a lot about the real estate cycle, and the real estate cycle is what drove the credit expansion historically. This fiscal spending and deficits here, it's looking pretty ugly. It's looking pretty ugly. And this could be one area that sustains inflation going forward that they cannot stop. They are going to we have to go through a period of what I would consider to be very high inflation and probably an increasing interest rate environment for a while. Money's going to rotate very differently under this environment, guys. It's going to favor precious metals. It's going to favor commodities, just like it did in the 40s, 50s, 60s, and 70s. And with the shortages that we have and the tightness of commodities on the supply side, I suspect that commodities will be a good sector to be in. Oh my God, for the EIA, crude with a deficit of 12 million barrels. We also had deficits in gasoline and distillates that were pretty big. We are sucking down that crude oil and gasoline today, boys. Maximum panic usually coincides with minimum prices. That's that fear trade that everyone talks about. Be greedy when others are fearful, aka the minimum prices, and the maximum panic. Coming down to Richard Meyer, U.S. natural gas is on the verge of becoming the #1 energy source. You can see natural gas just ripping higher. It's about to overtake petroleum. That is at the expense of coal, which coal has declined rapidly, specifically to the United States. My brother is in the energy business, and his company was massively replacing all of their coal power plants with natural gas power plants. Natural gas is the swing producer here, and it is drastically coming into favor these past 5 years, and I suspect it's going to majorly ramp up around the world for the next 15 to 20 years. The SOFR spiked to a record high yesterday. What's the SOFR here? So is the financial system beginning to crack, according to Joseph Brown? What this means and why it's a big deal, this is an overnight lending rate and represents excess liquidity or the lack of it. If rates spike, it's because everyone needs cash and few have it to lend out. The same thing happened with the repo rate in September of 2019. The cause then was the same as the cause now. Not enough cash in the financial system. Today, it's from a combination of excess government deficits paired with Fed's quantitative tightening. Basically, the government is trying to borrow more and more while the money printer, Fed, is doing the opposite of printing, it's shredding. At some point, the system runs out of money, and when it does, the cost of money spikes, the SOFR hitting record high. When this happened in 2019, the Fed started not QE and began printing again, but just for overnight lending. This time, they will face opposition to make a move like that because inflation is above target still. Liquidity issues are here. The financial system is showing deep signs of stress. This is the first of many cracks to appear, which is the SOFR spiked to 5.4%. Liquidity is drying up. Here's an all-time low number of stocks are outperforming the S&P 500. Notice something here. I just want you guys to notice something. This also occurred in 1974, which is at the beginning of a commodity bull market. 1980 was the end of a commodity bull market, and interest rates were really high. 98, 99 and were also the beginning of a commodity bull market. And here we are again with two low areas in 24 and 2022. And guess where that is located? At the beginning of a commodity bull market. You are correct. Coming down, for emerging markets to rally, we need the dollar to stop being so strong. A weaker dollar also sent commodities soaring last bull market. Watch yields and other currencies for the move. We've got a declining wedge, and we've just been trading sideways here, and I'm looking for a big move upward in the Brazilian real outperforming the US dollar. The dollar usually gets weaker when interest rates fall, and I think that we could be close to a declining interest rate environment. Same with the Canadian dollar. Last bull market of commodities, it originally started in 98, 99. It surged higher, we pulled back, and then we ripped in the big third and fifth wave from 2002 onward. That is the dollar weakening against other currencies. And I think we are in a falling wedge in a similar situation to 2002, right before that big move occurs. And we also have the Japanese yen weakening against the dollar at the current moment. And then we have the US 10-year bond. And this is really where, if we get a break higher, the dollar usually strengthens. If we get a break lower with a lowering of interest rates, that is where I think the dollar is going to follow. That's the driver. So Greg Rabbit Financing, I truly believe that Bitcoin is a liquidity trap that the West created to prevent the flow of capital into precious metals markets. When you talk about the ability to debase people through inflation, their savings, and their 401k, a liquidity trap is the precursor to total control through a central bank digital currency. The West knows that a rival BRICS system backed by gold and commodities will eventually present itself. This trap prolongs their fiat system, while citizens of the West will think they've gotten out of the system with BTC, only to be left holding fool's gold. The perfect storm for accepting a CBDC after they rug stocks, bonds, and Bitcoin. Your average person will be left with absolutely nothing to show for. I kind of like this guy because I believe that he's right. I am not in Bitcoin because I think it's garbage, but that is my opinion. You can obviously disagree. You can say, look at the past history of its performance. Fine. That is all well and done, but I do think that it being an asset with nothing behind it, it very well could soak up liquidity and save the fiat system a little bit longer if they can get people to all run into technology stocks and Bitcoin, which is it's a non-real thing, non-tangible item. Lisa says the increase in continuing jobless claims is notable as it goes up, and that's not a good sign. That definitely is a sign of weakness. Trying to unsee it, the US dollar going up against the Japanese yen, and the yen is just, it's a wreck right now. We've got my humble opinion. This is not the most important chart for gold and gold macro. When will it bust through resistance? This is gold versus the 60-40 portfolio. Looks like we could maybe head higher there. And this is gold on the top there. We've got global macro. The yield curve is steepening for fiscal reasons, not rate cut reasons. And that's what I was talking about, the steepening of the yield curve. It's because the long end has been going up and not because of rate cut decisions. Now, I don't know if that's going to hold true going forward. I don't know if we're going to break yields to the upside or the downside. I don't think anyone knows that yet. And we'll find out here probably in the next year. Investment wisdom, expect and react to change. No bull market is permanent. No bear market is permanent. John Templeton. And that's what you want to be really good at, is to identify bull markets and bear markets when they are in transition. Gold has not broken out into a resumed secular bull market, and this chart shows gold miners turning versus tech companies. The big asset rotation is starting right here. As said, for 4.5 years, this commodities bull market will be the greatest opportunity in our lifetime. An 8-year perfect bullish falling wedge that's ready to break to the upside for GDX versus the NASDAQ. The tech stocks will eventually peak sometime soon, and we are going to rip. Silver, after breaking the box, the silver rallied 8x in 24 months, $250 silver in 2026. Possible, very possible, super long here. I'm super long as well. Brandon Balo says, yet another major auto OEM walking back its all-electric vehicle future. This time, Mercedes-Benz. They're switching tone and investing in high-tech ICE development. More hybrids, better ICE engines, all require platinum group metals. Platinum group metals. And I have ways of playing that on the website. When I was a boy, there was a popular saying, don't just sit there, do something. But for investing, I'd invert it. Don't just do something, sit there. Develop the mindset that you don't make money on what you buy and sell. You make money on what you hold. Again, it is on what you hold. The hardest part is holding. I'm going to tell you this again, guys. You got to hold through the volatility. If you're going to try to buy a bottom and get a 10 or 20x, you have to buy it when it's cheap. You have to hold it until it appreciates, probably through a couple of pretty nasty pullbacks to get you where you want to go. If you want to be wealthy, if you want to make money from the markets, you have to adopt yourself to what the markets can give you. And you have to gain the skill sets and be a product of what the market is and desires. Silver, SLV, recall, also I was looking for it to hold for a quarterly and semesterly breakout, which we got, and also held above the quarterly Ichimoku cloud. Now we just need to flag B out and motoring here. So B out, we're ready to rip. And this is for silver SLV. Looking good. The gold miners ETF, GDX, is now trying to break out. Many are worried about the miners are not outperforming metals big yet. It is not unusual, though, for metals to break out big before miners do. But when the wall of worry lets go, we will see 8 to 10% up days for GDX and 10 to 15% up days for SILJ. A true generational opportunity is unfolding. This commodities bull market is going to be the ride of our lives. And this is GDX versus gold and a potential break here. And that's also what I follow. I follow XAU divided by gold price, gold futures. We're trying to break out right now this big long-term wedge for GDX, the large gold miners, guys. It is ready to go here very soon. If you hold gold or US dollars, it's a great time to visit Japan as the Japanese yen just absolutely gets demolished by the dollar. That's what this chart is here, the dollar versus the yen. Coming down here, it says the Chicago PMI, the manufacturing, saw a 3 standard deviation increase in June. We went from manufacturing recession to outright recovery in a month. Or is this just a noisy time series that has seen signal degradation post-COVID? Regardless, there were plenty of doomers in May who are now silent in June. So we'll see what occurs here. We've got a lot of data going up and down. And right now, it is favorable for recovery, what I'll say. And that's only right now. And that's where I'm going to end it. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. If you like, we have a question and answer session coming up this Saturday. Love to have you there. It's where we go over whatever questions members have. And I usually lead in with a couple of my opinions, some data perhaps, and some things that I've learned over the years. And we'll continue to do that. So that's what I've got for today. I will catch you next time. This is Finding Value.